Hey, everybody, good morning to you. My name is Brent Morris. No, I am not Kevin Horner. I know some of you are expecting Kevin. Kevin's actually out on vacation, but he will be back tomorrow. So, exciting week ahead, and I'm glad to be with you. And I'm also glad to be joined by a co host today, Mr. Michael Urizzo. Michael, how are you this morning?
Awesome, Brent. Awesome. Appreciate it. And appreciate that was the first time you pronounced my last name. I gave it to you once and you got it perfect. So I love it.
All right, thank you. Well, I'm glad you're here. Just be sure, everybody, you can follow me on X if you're interested at Brent Moore's CS. Are you on X, Michael?
I am not. I am not. We haven't cleared that bridge just yet.
Oh, okay, very good, very good. All right. Well, hey, let's hit a few disclosures up, and then we'll go through, get to the heart of the matter. Exciting week ahead, and so we'll get to that. Markets are often an interesting start for the week. The information today is for general informational purposes only, and is not considered to be a recommendation of any security strategy or chart type. Options carry a high level of risk and are not suitable for all investors. And short options can be assigned at any time up to expiration, regardless of the in-the-money amount. Schwab does not recommend the use of technical analysis as a sole means of investment research. And all investing involves risk, including loss of principal, potential loss of principal. And I also want to mention one other thing, and that is we're joined by Barb Armstrong in the chat. Appreciate Barb for being here. Barb was just out in Chicago for a workshop, and I know she had a good time. And Barb's a good friend, longtime colleague, and is helping us out in the chat here. And I want to welcome each of you, whether you're watching live or on a recording. And what do? Well, we're going to look at the general trend of the market. We're going to look at these major market indexes. And then I want to we'll look at individual sectors, areas of strength in the market. We'll look at just different time frames, support and resistance levels. You guys get the picture. If you've been here before, you know what we do. And so let's hit up. Here's the Thinkorswim platform, everybody. And I have the S&P 500 up. And so this, just to orient everybody, I've got a 6-month chart on here, 20-day moving average, 50-day moving average. We jumped right up to that 20-day moving average. Last week, I did Trader Talks the last 3 days of last week, and this is where we were last week. I expressed some concern that we had a nice little bounce, but we were kind of going flat, and it was going to be interesting to see whether we broke above or below this little channel that we had. We broke above, Michael. What are your thoughts on the market on the S&P 500, particularly this morning?
Yeah. Obviously, there's a it's a multivariable equation we're kind of working through here this first quarter, and obviously we have a couple of days left in the first quarter. So it wouldn't be it would be inside the norm to see a little bit of a relief rally from time to time. I think to me what's really interesting, Kevin and I talk about this on this segment pretty often, or something I like to interject pretty often. I'm watching the sector rotation internally within the S&P 500, right? And you're seeing what's lifting it now is a little different than what lifted it before. So, you could take two positions there. You could say, well, other sectors are helping. So now once maybe information technology starts to rebound, and we're seeing that there, maybe that is the next wave, so to lift this. But to your point, right, we're at some critical areas right there that we still need to do some work through. And, the market sells off pretty good on pretty good volume. I feel like the rallies are a little lighter on the volume that we're watching here. And that's always something that, gives me a little cause of concern just to look at. I think most traders would kind of take that opinion in the marketplace. If the liquidity is telling you one thing versus the movement, that's where you start to put your caution flags out there, or maybe change some of your risk management protocols. If you're in a trade like this, where you're trying to maybe get that relief rally, or maybe you're in the opposite trade, right, where you're actually banking on the S&P going a little bit lower over the next few days into the end of the quarter, and maybe you're getting a little bit nervous there. Again, maybe just an opportunity to change some of your risk parameters, but be mindful, like I said, of that sector rotation, that underbelly of the market. The breadth of the market, so to say, is changing a little bit as far as what's leading.
Yeah, absolutely. We'll take a look at the market breadth. Here's the infotech sector that you mentioned there, Michael, and you can see we had this jump up here. For a lot of 2024, infotech was leading the markets. Big sell-off, obviously. In terms of percentage sell-off from high to low this year, let's just take a quick look here on this. High to low, that was about a 16% sell-off in infotech, whereas the S&P 500 as a whole, and obviously we're not at the low anymore, but the S&P 500 as a whole was only about 10% or so. So obviously a bigger move down in infotech than the rest of the market. But when the market is bullish, infotech tends to be well, a leader. Or at least traditionally we've seen it as a leader. We'll see this time around. Let me just switch this up a little bit. Here's the S&P 500, which we were just looking at. Let's look at the S&P 500 equal weight and see if there's any differences there. So interesting, we've actually broken a little bit above, and instead of the gap on that equal weight, you can see the difference partially between the infotech, the infotech and the S&P 500. When we talk about the S&P 500, obviously dominated by a lot of like those Mag 7 stocks, you know, the Apples, the Amazons, the Alphabets. Those are the dominant players in the S&P 500. They had that gap up. This morning here on the S&P 500 equal weight, again, a nice jump up over 1%. We're right above that 20-day moving average here on that. So we are getting some broader breadth participation in the rally here. And if we do look, well, let's go a little bit longer term here. Let's go to a three-year chart on this. Here's the S&P 500 equal weight. You can see that on here. I'm just trying to, let me just draw this on here. You know, we've kind of had this here on this, and you can kind of see this pattern. We were kind of breaking below it, but that would be a pretty significant break. That would coincide with a 20-week moving average, by the way. What's a 20-week moving average? A 20-week moving average, 5 days traditionally in weeks. So basically it's a 100-day moving average. That's potentially a resistance level for us here on that S&P 500 equal weight. Let's take a look at the NASDAQ as we go. NASDAQ bounce up. We're right at that 20-day moving average. Any thoughts on the NASDAQ there, Michael?
Yeah, I think it's, kind of the same concept, right? You see it's a little laggard. In previous shows, we've shown that the steepness on the decline was much, much steeper in the NASDAQ, the S&P 500, but we kind of saw that acceleration now in the S&P 500. So, is the tail chasing, being chased by the dog, right? So I think sometimes we're the tail wagging the dog, so to say. And I think we're watching, like I said, those rotations through these indexes. So again, what you're doing now, right? Looking for those different correlations. Even when you look at like the equal weight S&P, and I'm sure you're going to see some of that kind of correlation in the NASDAQ, although the breadth of stocks are going to be very, very different, not just in their size, but style, right? Obviously, NASDAQ more geared towards the tech names, and then, some startup type growth companies mostly. Point being is, like today, right, what's leading the sector so far is kind of consumer discretionary, right? So that's one of the biggest laggards, coming into this moment. So now we're seeing a little rotation there. So as you said, you mentioned those Magnificent Seven, right? That's the constituents mostly of this NASDAQ that are really the proponents. And we've seen them kind of some surface cracks, and, they got some work to do, especially, some of the larger ones that were really, really carrying the weight, so to say, last year. But that's a pretty nice move in Microsoft, considering. So maybe that's leading the pack on tech, which would make a lot of sense, right? I think we got very AI heavy with the whatever verbiage, whatever got attached to AI. Got a real big pop, and now you're starting to see earnings come out, and you're starting to see some of the conjecture and obviously the global or the geopolitical landscape, tariffs. What I said on the onset, right? Got a lot of variables for these things to work through. So it's not surprising to see a lot of volatility, but it's nice to see that some of those consumer discretions, and Amazon, right? They're starting to pick themselves up as well, which is really, really good to see from a market participation. Now, is this because we got that little conjecture about rates in June and maybe 2 to 3 cuts for the whole year? Sure. So now there's, again, some jockeying of position since last week.
Yeah, no doubt. And here's the consumer discretionary chart. You can see that. Obviously, a lot of times we'll distinguish when we're looking at sectors between defensive sectors and those sectors that are more cyclical. those sectors that are more cyclical, in other words, those that tend to do well when the rest of the market is doing well, when the economy is looking good and people are in more of a willing to take risk, are consumer discretionary would be one of them, and including and infotech we kind of already mentioned, that would be a lot more cyclical of a type sector. Those sectors that we call consumer or more defensive sectors, those are ones like staples, consumer staples. When things are going south in the market, they tend to drop a lot less than the rest of the market. So we saw the drop that we had before in some of those. Here's staples. Here's the max drop. That's not going to give me the percentage if I go all the way there. Here's high to low in staples. We saw about a 7% drop in staples. So you can see that went down less than the rest of the market. Healthcare. Here's high to low in healthcare. How far did healthcare drop down? About 4 or 5%, something like that here in healthcare. Much less. Real estate. Real estate down about 7%. So those would be sectors that we would consider to be much more defensive in nature there, and we're seeing that. Now let's switch gears here, real Michael. Let's talk about small caps a little for a sec, because in terms of things that have been hitting the market, I mean, we talked about some of those more cyclical sectors like infotech, but the Russell 2000, which are small cap stocks, really got whacked here over the past few months. Any thoughts on small caps?
Yeah, so the Russell is something that's we've been talking about probably since 2 Octobers ago, when it kind of started to break out a little bit. So this is definitely a hot topic that we've been having, because again, it shows you some of that breadth of the market, some of the momentum in the market. So even looking in the small cap sector, right, what's rotating there is very different than what's rotating in the large caps. So I think in large caps, you're seeing consumer discretionary, utilities, energy stocks are kind of leading the way, where here it's healthcare is kind of leading the pack today. Very, very small. It's not getting that kind of pop. But even from a year-to-date point of view, right, like the entire sector is getting whacked pretty hard, but consumer discretionary is the hardest hit. So again, that inverse from the large cap. So again, things to think about, because, correlations work until they don't, right, is what they always say. And when things start to, have that inverse correlation, or they have a stronger inverse correlation, it's either maybe an opportunity in the marketplace, whether to, mitigate risk or actually take, on a new position or maybe add to.
Yeah, no doubt. And, if there is more concerns for economic softness, and the narrative's been a little mixed lately on that. Last week, at the beginning of the week, we had a retail sales number that wasn't very good. But that's more concerning for a lot of small cap stocks than it is which aren't in as solid a financial position as a lot of large cap stocks out there. So that's what we're seeing there, and you can even see things reflected in the difference between growth and value here. I'm going to put in there's different indexes. Let's see, SP 500 PG, I believe. Yeah, here's your pure growth index here. There's different indexes out there for growth and value, and sometimes stocks have characteristics of both. And so some value indexes will actually, some stocks will actually find themselves both in a growth index and a value index in the same time. These two that I'm about to show you are ones that don't do that. They only take the ones that just have pure growth characteristics or pure value characteristics here. So you can see the difference in growth and value. And of course, at different times in the market, growth has outperformed value, and at different times in the market, value has outperformed growth. But in terms of the move down, a more significant move down, I mean, down 17, 18% in this growth index that we've had here. Whereas if we look at the value version, basically, of the S&P 500 index, instead of that 17% down from the beginning of the year, I mean, it's not much at all, since this one actually started to decline a little bit earlier last year. I mean, it's kind of weird because we had this decline back in 2024 of about 10%, but actually we've then gone up since that time. So clearly some shift into more value stocks. Well, market valuations maybe are a little bit better now than they were. And that goes back to what you were saying, Michael, about that sector rotation. Some sectors tend to fall more in the growth category than the value category, right?
Yeah, well, especially over, it's a perfect segue for me, and appreciate it because, I was kind of thinking like, I was having this conversation actually with a few clients the other day. I am in a client-facing role when not on this opportunity, and having a lot of conversations with clients, again, that not necessarily nervous, right? They knew this moment was coming, but now things maybe are shaking out a little bit different. My point being is, and you brought up volatility as well, right? So like if we look at the S&P 500 over the last, 75 years, give or take. I think it's like 1957 or something in that realm where it was initiated. So from its inception of the S&P 500, right, we have like a historical rate of volatility around 20%, give or take a little margin, up and down, standard deviation, so to say, right? So that volatility measurement. Well, over the last 25 years, that went down to 15%. So we had a 5%, well, roughly 5%, maybe just a little shy of. My point is, over the last 25 years, that high growth sector that has really just been on fire, literally to the upside, that's kind of been carrying us through this large bull market. Not to say that we weren't getting participation throughout the 25 years from other sectors, but realistically, right, this last big move up was kind of that Magnificent Seven, very info tech, right? So my point is, now those are the ones that are dragging the sectors down. So volatility over the last 25 years was about 15. We're seeing it over the last 5 years, now about 17 and change. My point is we're creeping back towards the norm. So what got us low volatility moments will now get us high volatility moments. And, that's kind of the way the market works, right? So to your point, we're seeing a little revaluation and growth is maybe being dialed back. And there's some real values out there. We see the commodity space. Obviously, there's a lot of opportunity there. We've seen them base metals. Gold is all-time highs, right? 3,000 for the first time ever. So it's like you got to step back and be like, all right, what's really going on? Where is the opportunity to like look at my portfolio and maybe take opportunities or maybe trim some risk off from some things because maybe I don't want that increased volatility over the next 2 to 3 years that seems to be the new pattern.
Yeah, that's a great point. And something I want to just mention, everybody, just to maybe go a little bit deeper into what you were mentioning. When we're looking at the market, there's kind of two main things that people look at in terms of investment returns, whether we're talking about stocks or different asset classes, bonds or whatever else. There's the kind of what we call the risk element of that. And you mentioned the word standard deviation or the volatility. So that is how much up and down it's likely to go in a year. So if we said, the standard deviation is 20%, well, our expectation is up or down, plus or minus 20% during that period of time. Generally, investors don't like that move up and down. The other element of so it would be preferable if we had very low standard deviations, but at the same time, we had very high rewards or returns, I guess I should say, higher returns. So the ideal asset class or the ideal investment would have high returns and low standard deviations. But we live in the real world, and the real world is it doesn't work that way. Typically, what we find is those that tend to historically have higher returns also have higher standard deviations. So when you look at a portfolio and you look at a stock portfolio, what they tend to have is they tend to have higher, as they say, stocks versus bonds, we'll say. They tend to have higher standard deviations, but historically, and I'm not saying about anything going forward, but historically, a stock portfolio had higher returns than a bond portfolio. So what do people do? What they do is sometimes, and this is not a recommendation of an exact percentage, but this is just an example. What they'll do is they'll take their stock portfolio and they'll try and say, hey, I'm going to put, say, 70%, again, this is an example, in a stock portfolio. because that's in the past has given me higher returns. And then they'll put, say, 30% in a bond portfolio, because even though the returns aren't quite as high historically as what stocks have been, what it does is it tends to lower those standard deviations very significantly. And so you sacrifice a little bit on the return for a pretty big help in terms of the standard deviations or the risks of the portfolio. Now, this is a very simple model here, this stock bond portfolio model, but there's other asset classes. Michael, you mentioned gold. Well, gold has just been teetering, I've been touching all-time highs of late. And so gold historically hasn't been the greatest investment in terms of returns, but the last couple of years, it's been knocking it out of the park. And so you have, and then what about real estate? Well, real estate is a different asset class you can talk about. There are other commodities. I mentioned gold is one commodity, but that's another asset class that you can throw in there and add some to the portfolio. And that way, when the market is struggling, and stocks are lagging, some of these other asset classes kind of help pick it up. It also helps to lower your risk, your standard deviations in your portfolio. Any thoughts on that, Michael, before I move on?
Yeah, absolutely. Right. And this is a conversation that I'm concurrently having with clients, pretty much always. We have our traditional models, the 70-30. That 70-30 really hasn't worked over the last 25 years, to my point before. Right. And why? Right. Well, the reason why is because we were getting outside gains out of, higher growth sectors that were leading the market. So, remember those averages I said before, the standard deviation, right? So the market average, they'll say the market over 100 years returns about 7%. Well, the S&P 500 is about 7 and change. Right now, we've seen a lower standard deviation over the last 25 years, and we've moved probably more towards like 8.5%. It's actually moved the needle to about 8.5% because of the large 12, 15-year bull market we saw after the 7-8 recovery, right? So the point being is people are going to alternative assets instead of gold. They were going to private equity and alternative assets to get that extra alpha because they could have, because of the way the market was shaped. Well, now we see the market turning over. It's not just that the market sold off and it's going to recover. We get these V-shaped rallies we're really used to. Now it's like that next rally, the constituency is different. So therefore the standard deviation. So this might be an opportunity to get, more level growth, more S&P-like return at a lower standard deviation than the last 25 years. Because to your point, some of these stocks are a little bit defensive. Energy is obviously on the move. Oil's low. So there's opportunities there that people are seeking as well, as they expect that the demand for oil, we're still kind of recovering from the COVID moment where the demand for some of these precious metals and oil was kind of laggard while the market's repricing, right? And we're watching that repricing. So I think it's also watch how it's repricing risk is what I would kind of say to sum that up.
Very good. Very good. Awesome. Thank you. Let's move on and let's talk about some things in the market in terms of, we're kind of in this lull of earnings season. And just a reminder for everybody, if you are interested in seeing what's coming out on the earnings calendar, here's today's heat map, by the way, on the Market Watch Visualize tab. A lot of green in the market. This is the S&P 500. Well, let's take a look. I mean, maybe a little more weakness over in the healthcare area there. Not terrible, maybe, but a little mixed. But you can see those sectors that you were talking about, those sectors of strength, and these two kind of get talked about often in tandem, IT and communications, and then consumer discretionary and financials there. And so that's a pretty good looking heat map, by the way. And if you ever want to see the kind of the breadth in the market too, you can always go on that Visualize tab. You can go to Index Watch and you can select whatever you want. Let me go to S&P 500. And you can see how many advancers and how many decliners we have right now in the market. 440 out of 500. That's not too bad. It's actually showing us 501, and that 501 is, I think, mostly because of Google has the two shares of classes in there. But that's a pretty good market breadth we're seeing in the market right now, which is generally a healthier sign in a rally. We usually don't like to see just a few of those companies that are outperforming here. Let me go though and look at the calendar. So let me get rid of my symbol in there.
Brent, just a quick point there, kind of back to what, kind of in the same lane you're driving here, of course. Just looking at the advances declines, right? We had a big option expiration in a quarter that's been pretty tumultuous, right? So maybe this is, so again, you're getting a relief rally, possibly is kind of my first thought process, right? Because you're seeing it. That's a pretty strong advance decline to your point, right? So why is the question, is it so strong today? What's changed over the weekend? So as you're digesting the news, but like I said, always be mindful that big expiration at the end of, that's the triple witch, right? It's the largest expiration because it's the quarterly one. So like, maybe people that were taking, bullish stances in the markets, in the options place, kind of took those trades off now, and maybe they're looking to put some money back to work. If that was the way they kind of positioned their trade. And I think the options market has been telling us that people were definitely buying protection, versus selling options, so to say, in the last quarter.
Yes, and I think we saw some of that. I'll get back to the earnings calendar in just a sec here. But we could see the VIX dropping down here on this, and those VIX prices get elevated as people buy protection often on that, or are more worried about the market. Well, we peaked out here. In fact, I'm going to go out. Let's go to a year chart here on this. Actually, I'm going to. That's
a great point too, right? And like I said, thinking about this, we're coming into the last week of the quarter, so now we're seeing a little bit of a rally. So, like, watching that VIX, if you watch it through the next few days start to creep, you're like, all right, there's a possibility then the market is trying to show you that it's going to price in a little bit higher prices, going into the quarter. Maybe the worst is over for the moment, but then again, remember, headline risk is just about as large as it's ever been. And it's kind of been like this for many years. But right now, because of the geopolitical, and like I said, the tariff space, headline risk is huge right now.
Yes. Yeah, it sure is. We don't know. I mean, we've experienced this for a little while, and that's one of the challenges we have right now is there's a lot that we don't know. In last week's presser with Jerome Powell, he said, hey, look, right now, there are concerns, obviously, in the markets, but there's some things that we need to watch for. But he said, there's been concerns about the labor market. His take, at least my interpretation of his take was, he's actually fairly comfortable with the labor market right now. But there was a couple areas of uncertainty. And this is, when we talk about uncertainty, the VIX is measuring uncertainty, right? Bad news can be priced in, but it's the unknown that's more of a concern. He said the two biggest areas of concern right now is the discussion with tariffs and with inflation. It's still a little iffy. And those are the things that could certainly push interest rate change the monetary policy, the interest rate policy, and in the markets right now. And there you go. That's that you can see this reflected in our VIX is about 18.5, which is relatively high. My hand isn't going to be steady enough to draw a perfectly straight line here, but this is kind of where we are right now. You can see the times of uncertainty, we're peaking above it but dipping back below. Well, that's about where we're at. The question is, given the kind of this underlying headline risk that you talked about, Michael, how much lower can the VIX go? It seems to me probably unlikely we're going to dip below 15. And it seems like we're more likely to level out, moderate out a little bit than keep its descent going.
Yeah, and look, I think somebody, a couple things that I think I kind of saw pop up in the chat. Somebody saying obviously some of the tariff talk over the weekend. To your point, Jerome Powell's conversation. Kind of my I guess hair on the back of my head always stands up when he says the word transitory, and that's kind of how he's referencing the tariffs too. Which, while we might say, well, that does make some sense, right? To your point, these are variables at play. These are postures at the moment. There hasn't been a ton of obviously there's some action and there's some repercussions of those actions we're seeing. But at the end of the day, right, April 2nd is kind of on the horizon, and obviously the administration has been very, very firm on saying that April 2nd is going to be this really impactful day. So the next couple of days, right, to your point, will the VIX probably retreat to its mean? Well, yeah, if we keep getting the advanced declines and we're getting this rally, whether it's a relief rally or it's a stronger rally, yet to be determined, right? So yes, it would make sense that the VIX in this moment would start to drift down. But like I said, we're seeing the opportunity where we can get this like quick pop out of nowhere, so to say. So it'll be interesting to watch how people starting to price, that April expiration, how they're starting to price. Are they buying protection, right? So the breadth of that, the put call ratio, the VIX, these are things you're going to be watching for in the next few days to see if you can get that early signal, so to say. Because, we look at technicals all the time, obviously, on these broadcasts, and they're great. But again, to your point, right, we always say it's not the only thing. Well, the technicals are telling you a story. Now it's time to go uncover where that story is coming from, because otherwise, bluntly, we're all looking at the same charts. Yeah.
Yes. Yeah. Good points. Thank you, Michael. Okay. I was going to the earnings calendar, and I kind of got sidetracked there. So let's hit that earnings calendar up. And I don't want to look at every stock out there. So let me just go. And I'm going, I don't want to do that. I want to go here, and we'll kind of narrow this down to the S&P. We'll go S&P 100, in fact, to really narrow it down. It kind of shows you earnings season we're not really, last week we had a few, including FedEx, which, that's kind of, a lot of people consider that as a kind of a thermometer of the market in terms of activity, and given not so great retail sales numbers, FedEx expressing some concerns going forward, and Nike had they've just been in bad shape the last couple of years, and I don't think expectations were very high for Nike, but they still failed to come up, and they really dropped on earnings. But coming up over the next week, nada until April 11th. And that's when you start to get, April 11th would be kind of the traditional start of earnings season here, because that's where you get you got BlackRock, Bank of America, New York Mellon, you got JP Morgan, Morgan Stanley, Wells Fargo. April 11th, that's the kickoff to earnings season here. So we're kind of in this lull of that. There's plenty of risk, though, in the market, plenty of going on in the market without earnings to do that here.
Yeah, but Brent, I think your point is really, really well received, at least by me and hopefully by other folks, and I think other traders in the market would agree, right? We're bracing for what's on the horizon. We're thinking about and planning for that. One of the big ones there, right? One of the first call outs I see there, right, is you obviously have, financial sector, which is one of the sectors that has had a little bit of a benefit, recently, and especially probably one of the sectors that was kind of helped lift the market a little bit last week and even today, right, with some of that, news about interest rates. So again, that's on the horizon. So those earnings are going to be kind of pivotal to see if the new pricing for that June rate cut that's about, pretty much on the horizon there, right? So I always encourage folks to look at the Fed dot plots. You can see those percentages change over time, right? That'll give you a little intimation. You're bringing it up. I think somebody mentioned in the chat too that TNX was moving a little bit as well, right? So it's up on the day. So these are all those things, kind of to your point. One big one that I think is on the horizon that folks are starting to talk about, and I know a lot of clients, hold positions in, Tesla, kind of mid-April, right? Tesla's been under a lot of scrutiny. There's a lot of things out there about it, a lot of conjecture. Well, the earnings are going to prove, like, is the conjecture true, or was it just kind of, market jargon, talk, and earnings, we're going to come out strong. So again, that's one to watch, and it kind of falls into that NASDAQ story that we've been talking about as well.
Yeah, I mean, Tesla's roughly half the price, at least when it was a little lower than what it was a few months ago. It certainly had a nice reaction. I mean, this was the election, and people seemed to be very positive on it. There's this it's kind of a weird political element right now with Tesla that you don't see that often with most companies, but we've seen Tesla run up and then just get destroyed here. Well, at a certain point, it becomes cheap enough, and maybe that's the point right now. Of course, it will still be in the news going forward. There's still a little of uncertainty on that, but we have had a nice bounce on that.
Yeah, and to your
Yeah.
point too, right? I think, based on just conjecture, right, and what we're hearing out there, you're seeing some noise out there that, maybe he's a little distracted and he's not giving Tesla the full attention. You're seeing a price drop because of that. It kind of reminds me, and I know we've talked about this on the broadcast. We talk idiosyncratic risk all the time when it comes to single stock names, but when
Yes.
you think of the Nvidias and the Teslas, like they're kind of hedged to an individual as well, right? So their driving force is an individual, which that's a type of idiosyncratic risk, unless you want to, go to Lloyd's of London and take out insurance on an individual. I don't know that you can really price that in the market from a risk point of view. So again, if you have that concentrated position, maybe you're holding on, maybe it's worth thinking about, trimming some of that risk, because if those earnings come out and what the conjecture is true, Tesla could have some headwinds for the next few years. That 2030 mandate was already said was not going to be met. So that is I think that was the first crack in Tesla's pricing. And then we've seen some stuff there. So again, not saying that it's not an opportunity from a trading point of view, but if you have that longer term view where you're more buying and holding this, just make sure you can be braced for the volatility that it's starting to show us will be around.
I think that's a key point, Michael, because there are things that are easier to price in. Conventional valuation models will help you price in a lot of stuff, but conventional valuation models aren't going to price in, a CEO that's controversial, that's a central part in the new administration, and political backlash regarding that. Well, I don't know any mod. I don't know how to value that. And so that's one reason why people use technical analysis is, look, the fundamental analysis becomes very difficult on something like that.
Yeah.
And not that technical analysis is foolproof. We kind of encourage people to use a holistic approach, I guess, or just, remind you that technical analysis is not the only approach to the market. But in light of that, I think a lot of investors find themselves more reliant on technical analysis when you talk about that idiosyncratic risk that you mentioned there on that, Michael. So I appreciate you bringing that up. You also had mentioned interest rates. Let's take a quick look at the interest rates here. So this is the 10-year yield, and of course we've seen a drop, and that's certainly helped it. We've seen an uptick in mortgage refinance activity and stuff like that. This is of late at least, seems like this is kind of the upper zone there, and then down here, well, I'll probably call that is kind of the lower end. Where are we going next, Mike? I know you can't predict exactly on this, but what are your thoughts on interest rates here on this?
Yeah, listen, I mean, I think, again, it's always going to be interesting, right, when you see this moving higher, when we're talking about a lower rate environment. Again, it just shows you that there's complexity that the market needs to work out over the next couple of weeks, months.
Yeah.
It's digesting this new information. You're seeing that kind of movement. So, it's always going to be pretty interesting to see rates going. So, look, we've been talking about the fact that I know I've been having client conversations, I feel like since probably, I guess, what is that, maybe June of 22-ish, give or take, about interest rates and opportunities there that weren't there in the bond market or fixed income market, so to say. So there's still some cool opportunities out there for this. So I think people are still positioning, like, as their rates are coming down in the future, they're positioning themselves now for that. And I think that's something that I've been talking to clients about too, is like, if you do, feel the conjecture is right, and then you do feel like interest rates are going to come down and that inflation is transitory and it's only a moment in time. Again, we're going to get some news over the next couple of weeks that'll kind of help that. That dot plot, I guarantee you, will look very, very different in the next few weeks to come, because we're just starting to price in this new news. And again, I think there's some conjecture between 2 to 3 this year is kind of where we're still stalling. So as we see 3, 4 maybe cuts come to this year, because again, as June becomes more close to fruition, so do the follow-ups, right? So if they go into June and they don't cut rates, then they're like, well, now that's changed the landscape. So we have a few months to kind of figure this out, I guess, so to say. So I'd be definitely concerned in watching these spaces to see how to position, especially if you're in the shorter term window of making a trade, or, you're looking at opportunities.
Yeah, a lot more uncertainty there. The farther you go out, we don't know. This is the dot plot that, Michael, you referred to here. There's different ways to look at it, but each of these little dots here on this chart basically represent a Fed view from a member of where the interest rate, where the Fed funds rate would be at the end of the year. So here's the 2025. Currently, we're up here. The median is, I think, for a couple, so basically it'll be 2.2, two cuts in the year. And then if you go out to the end of 2026, a year out, this is all, the Fed has talked about it being data dependent. There's a lot of uncertainty. So, don't take this to the bank as to what, exactly where things are going to be here, because we don't know. But this is kind of showing this general trajectory down of expected interest rates here on this.
I think one thing too is, even if you look in the longer run there, they're not really pricing interest rates to go back anywhere near what we had been accustomed to prior to this moment, right? So yes, interest rates might go lower, but what's the next new norm? It's probably not going to be zero, right? It looks like we're saying the next new norm. And I think they've been talking about this for some time now. The conjectures always be, 3%-ish, 3.5, something slightly under 4, close to 4 will probably be the long run. So that's, it's kind of indicative of what they've said before. We're seeing it actually happen. So now how do you set yourself up as a trader to work within those, new boundaries, so to say, or new guardrails from an interest rate point of view? Is that's what, you should be thinking about over the next couple of months, is how is this going to affect my trade plan? Even for those options traders, while I realize on a single option, a small movement in 25, 50 basis point in interest rates might not necessarily change that specific strike or that specific premium, but you think about all the premiums that changes over the accumulation of your strategy over a year, and you're like, well, I should expect lower returns probably because of those interest rates, plausibly, in my options premium. So, right, I think a lot of folks that I talk to get very accustomed to the premium, not realizing where it's coming from and how it can very, very quickly shift. And I think we're watching a lot of dynamics that will change the option market. And bluntly, right, the last 5 years, we've seen a huge boon in the option market trading in retail, especially, and getting into different strategies. So just make sure your strategies are set up for the market we're in and the market we're going towards, versus like, hey, it's worked before, it'll work again, I just got to wait it out. I watch a lot of folks, get challenged by that in their portfolios.
Great points. And just, in fact, we'll kind of wrap up with this, but let me just mention this. So right now we're at about 4.3 on this graph. You just moved the decimal point over one. What you're saying is, if we may go down, but we're probably not going down to 1%, 1.5%, 2%. We don't know where it stops, but there's a good chance the new normal is low interest rates are kind of more in that range than what we had down here. And so that does certainly affects the markets. It can affect some stocks more negatively than others. But higher interest rates means higher debt financing for companies, and means that maybe fixed income becomes a little bit more of a competitive investment versus the equity market as well there along the way. So anyway, that's great points from you, Michael. Thank you. I appreciate that. And, just as we're wrapping up, maybe you could just tell people what you do as your full-time job here, and not just as a frequent guest here on Trader Talks.
Yeah, sure. Absolutely. I appreciate it. And it kind of allows me to answer a question. I think Kevin, or K Brown, I don't assume your name is Kevin, K Brown in the chat, I think asked me the last time I was on a few weeks ago. So I never worked on the Pacific Coast Exchange, but to your point, prior to coming to Schwab, I spent about 25 years on the floor of the New York Stock Exchange as a specialist or a market maker. Depending on how long you've been in the market, that name has changed. Now they call it designated market maker, or DMM. You might hear, on some of the TV channels. But either way, right? So that kind of institutional trader, it's kind of this role here at Schwab as a regional investment strategist. I cover the Southeast, which is Florida, Puerto Rico, Alabama, Kentucky, and Tennessee. So I work one-to-one with clients and their financial consultants, kind of as a partner, subject matter expert for those financial consultants. So allows me to kind of play educator, just like we're doing here today. So really, really enjoy the education role. It's a lot less stressful than being tied to a P&L every day like I'm used to. But I think it helps me really with clients where I can kind of understand where they're coming from and work through the emotions and get more pragmatic about their trading strategy. So a really, really cool role here at Schwab.
Great. Well, hey, I appreciate you for joining me here today, Michael, and appreciate each of you for taking some time out of your day to start off a week. Exciting week ahead in the market. Kevin should be back tomorrow morning on Trader Talks with us. And I want to thank Barb for helping us out in the chat. Appreciate you. Barb, of course. And everybody, have a great week ahead, and we'll see you later. Bye-bye, everybody.